I would say it just in a slightly different way. I would say that when the price plot of Apple disagrees with the price plot of the NASDAQ 100 index, that you should believe Apple most of the time, that Apple usually ends up being the one that's right. And so it is troubling to see Apple going now below its October low, whereas the rest of the indices have not done that. So that is troubling. However, at the same time, Apple has not yet gone below its February low, while the NASDAQ 100 did. So which disagreement do you want to pay attention to? And that's the difficult question. There's a lot of reason to expect Apple to stop its decline this week, right about here. It's now touching the 200-day moving average almost exactly. It's filled the gap that it left on the August 1st earnings report, where it gapped higher. And so this is a very nice place for it to stop if it wants to. It could push through. It can do anything it wants. But when you're already down 17% drawdown from the recent high, and you've just now gotten to your 200-day moving average, it's really tough to make a push down through it when you've expended all your energy just to get to the starting line.
Tom, what do you make of the WTI oil chart at the moment, and whether that has implications for broader equity markets?
Well, it has big implications for bond yields, because the 30-year bond yield tends to follow the path of oil prices with a lag time of about 3 weeks. It's a pretty reliable, but not perfect, but it's a pretty reliable indicator. The correlation to the stock market is not nearly as reliable. It is quite the washout in the near month crude oil. You're not seeing quite the same degree of selling in the further out months, and so it's a near-term supply and demand issue where there's not as much demand as people were expecting, and there's a bunch of supply, and so that's pushing the prices down. But also at the same time, this big decline that we're seeing in oil prices, it's really not that big compared to 2014 or 2008 and 9, and so all it's really done is taken oil back down to the lower boundary of its rising channel line.
Tom, as a lot of us here, of course, keep talking about trying to read the signals of the market right here as to whether, in fact, it might be bottoming or not. I know you talked something about the seasonals, but what other indicators right now would you be keying off of to give you a sense of the kind of supply-demand setup right here?
Well, first, Mike, that was really nice analysis on the Head and Shoulders, and I agree with the way that you described it. And I'm thinking actually that there are more people that are poo-pooing the Head and Shoulders than are believing in it. So that double reverses the sentiment back around.
Yeah.
Well, I'm focused on entering the third year of the presidential term. The year following the midterm elections is up every time since 1933, except for one. In 1939, we had a 2% loss in the S&P 500 that year because the Wehrmacht was marching through Poland. And so if we were to have a condition like that in 2019, then yes, we could have a down third year. But otherwise, it's nearly always an up year, except that the first 2 weeks of November, right after the midterm, are not usually an up year. You get a little soft spot as everybody gets over the effects of what the news is on the election, and then you really start upward. So after about the 14th or 15th of November, a little bit later this week, we should see the upturn right on schedule.
Tom, just want to bring back to where we started on Apple. Despite those fears or worries about it falling and what it means for the market, you're actually long Apple, is that right?
I am long. I'm expecting it to go higher. I didn't expect this most recent decline that took it below 200, but I'm seeing it finding support right at the 200-day moving average, and I'm thinking that's going to work.